Amazon reported earnings. The stock is down 3% in the after hours, over 13% year to date. I own the stock. It has been a brutal year for the stock, for the company, for earnings in general. This report isn't exciting at all, and some of the fundamentals have been deteriorating. So I have to talk about Amazon. I have to give you an update. I have to analyze the report, let you know my fair value, let you know if I believe Amazon could still double or triple from this price over the next 5 years, or if maybe Amazon is still somewhat overvalued and we should wait for a lower price. So I really hope you enjoy it as always. Now, most of you guys know how Amazon makes money. I'm not going to try to explain the business model, but most of it is still through the Amazon.com kind of online store. Then they have some physical store like Whole Foods, Fresh, and many others. Then they have the third-party seller services, which is where the tariffs are hitting very hard right now. Then they have advertising, which has been beast, especially Twitch. Twitch has actually been very surprising to me. They have subscriptions like Prime and Audible, Amazon Web Services, which is huge, and other kind of businesses and bets and all kind of things, trying to go to the moon and rockets and the satellites and all kind of crazy bets that if they do work out, it's going to be amazing for the company. Now, if we look at the last report, it wasn't actually bad at all. They got $1.59 versus $1.36 expected. This is a massive beat for earnings per share. Same thing on revenues. They had a very decent beat on revenues, but everything else hasn't been going too well, especially AWS, which is Amazon Web Services. They got 29.3 versus 29.42 expected, and that was a slight miss. But what has really surprised the market was that AWS was pretty much the only cloud company that has really disappointed this quarter. Like if you compare AWS to Google Cloud, to Microsoft Azure, many other cloud providers, they have grown much faster than AWS, and they have even been taking market share from AWS, especially for Microsoft Azure. AWS is still growing around 17% year on year, but as you could tell in this quarter, the growth has massively decelerated for the company. Now, this is not new. Sometimes the growth has decelerated, even here you could say from December 22 to March of 2023, and then it has massively picked up. So one quarter doesn't make the entire story. Maybe this is just a one-off, but it's definitely something that we have to monitor for the company. Now, the advertising revenues has been shocking, 13.92 versus 13.74, especially if you compare the growth in the Amazon advertising business versus other legacy advertisers like Meta and many others. Amazon advertising business grew 19% this quarter versus Microsoft, which grew 15%, Meta at 16%, YouTube ads at 10%, and Google ads at 9%. So the advertising business at Amazon has been a beast, growing 19%, and it has outperformed all the other players in the space, which has been amazing. Guidance has also been somewhat disappointing. They expect second quarter operating income to be 13 billion to 17.5, below 17.64. So this is almost 4.5 billion on the low end, below the estimates. But this is really accounting in the tariffs, which are around 145%, because many sellers on Amazon's third-party marketplace, which accounts for more than half the company's total sales, rely on the world's second largest economy, which is China, to make or assemble their products. So over 145 tariffs, it's really going to affect the company. But many people like President Trump, a lot of people in the White House have said that the 145% tariff is likely the peak on China. And now the countries are finally negotiating for a potential deal. So if 145% is peak tariffs on China, it means that $13 billion is the worst case scenario for Amazon's guidance, which means the market right now is pretty much pricing in the worst case scenario for the tariffs, for the China trade war, and for Amazon in general, which means it's only going to get better from here. So that's how I look at it. I look at it as the market is pricing in the worst, and if something good happens, if good news starts happening with the company, then we're going to have a massive surprise to the upside, which I like very, very much. So I'm loving the risk reward reward for Amazon at this price in terms of what the market is pricing in right now versus the good outcome that could potentially come out of this. And there's some things that the market is entirely missing, is that the 145% tariff isn't just on Amazon, it's on 90 or 95% of retailers here in the United States. So it's not just on Amazon. And what has happened during COVID, many people came to Amazon because Amazon has the capability to weather certain storms and to lower prices. And Amazon has taken market share in terms of online shopping in general in the United States. And this is what the CEO has highlighted this quarter, that Amazon could emerge from the uncertain environment stronger than before, given its ability to offer low prices. Jassy pointed to the COVID pandemic as a period when shoppers flocked to the site and the company grew in its share. And the same thing could potentially happen again, because no retailer, no company in the United States is better positioned than Amazon to weather the storm, to offer value for customers, and to take market share from other kind of retailers and other players in general. Now, whenever I'm valuing Amazon, I like to normally look at price to operating cash flow. And price to operating cash flow right now is cheap. It's trading around 17 times. The average is at 25 times. But the operating cash flow growth has been massively decelerating from 82%, 75, 57, 36. Now it's only at 15%. I wasn't expecting the cash from operations growth to decelerate to only 15%. I was pricing in 20 to 25% in my valuation model. Now it only came in at 15%. And I really hope it doesn't get worse, because it's really going to mess up my estimates. But I believe 15% will likely be the bottom for cash from operations growth, as the company could really be much more profitable if they really wanted to. But they spend so much on research and development, so much on certain things like that, that if they could pretty much pull it back anytime if they really want it to be profitable. But Amazon doesn't really care about profitability. They don't really care right now in terms of returning value to shareholders through buybacks and dividends. Amazon is mainly focusing on its growth, and it's mainly focusing on widening and strengthening its moat. And once they have a grasp on massive TAMs, such as the financial sector, such as the healthcare sector, and in many different areas where Amazon is expanding, then I believe they will lower research and development expense, which is going to increase net income, which is going to massively increase net in terms of cash from operations growth and many different things. So I'm not really worried in terms of that stuff, because I know if Amazon really wanted to, they can show this profitability growth pretty much anytime. They can double their earnings per share overnight if they just lower research and development a little bit. But Amazon is focused on growth and is focused on strengthening its moat. Now, if I look at the analyst estimates, they're pricing in 25% cash from operations growth this year, then 20% growth, 18%, 11%, then 24% 2029. I believe this is too optimistic, and I used to use 20% growth in my previous estimates. In this one, I'm only going to use the analyst numbers for this one, which is 24.5%, because I believe it could potentially be achievable beyond Q2 for 2025, in total around 25%. But after that, I'm not going to use 20% and 25%. I'm going to use 15% for my estimate. So for 2025, we have 144 billion in estimated cash from operations. So I got 144 billion for the next 4 years at 15% a year for a total of a 5-year estimate. We got around $252 billion in cash from operations, which is significantly below the analyst estimates of 287 billion. Okay. Now we talked about the multiple of Amazon for cash from operations multiple around 17 times. I believe 17 times is low. The average is 25 times, but I'm going to use 17 times for this model. Okay. So we take the 252, we just going to round it up. We take the 252, okay, and we time it by 17 times price to operating cash flow multiple. We got around 4.2, almost $4.3 trillion of a market cap 5 years from now. The current market cap is around $1.9 trillion, which would be around 125% on the upside for Amazon over the next 5 years. This is using 17 time multiple versus 25, and this is using 15% cash from operations growth versus 20 or 25 times like I used to use and like the analyst used to put up. So this is, I believe, very conservative. The valuation could be higher. The growth could be even higher if Amazon really wanted to. They could even start doing buybacks later on in the decade and do many different things to return value to shareholders, and none of that stuff is priced in my model. So I believe Amazon at this price is offering an amazing risk to reward setup. I believe Amazon is the best positioned in retail and in kind of this kind of sector with a massive cash position and amazing balance sheet, amazing execution, amazing moat, amazing network, amazing stickiness of the business, and the ability to offer lower prices and better value for customers. There's no other company that's better positioned than Amazon to take market share and to come out stronger than ever before after this storm is over. So I like the company very much. I still believe the stock is a buy. I still own the stock. Nothing has changed in my thesis. And yeah, that was not the best quarter, not the best guidance, but one or two bad quarters, they don't really make up the whole story. We have to monitor cash from operations growth. We have to monitor Amazon Web Services growth. And then we can kind of determine if we made a mistake or if we need to adjust anything. But that's my thesis on Amazon, not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.